You just received a $25,000 sign-on bonus on your first day at the new job. The company deposited $16,337 into your account. 8 months later, you get a letter from HR. You owe them $25,000, but your account only has $16,337. The rest is gone, and the IRS will not give it back in time. If you are a job changer between 28 and 45 in tech, finance, or consulting, this is not a paperwork problem. It is an architecture problem built into every sign-on bonus agreement most people never read carefully enough. The math behind this is uglier than the headline. Most people treat a sign-on bonus like a gift. The company wants you. They write you a check. You feel good about your decision. You spend the money on the move, the deposit, maybe a dinner to celebrate. What almost nobody reads closely is the clause on page 4 of the agreement that converts that gift into a conditional loan the moment you leave before a specified date. And the way the math works at repayment time is nothing like the way it worked on day one. Let me show you exactly what happens inside the system. When your employer pays you a $25,000 sign-on bonus, the payroll system does not hand you $25,000. It treats the bonus as supplemental wages and applies a flat federal withholding rate of 22%. That is $5,500 gone immediately. Then FICA kicks in, Social Security at 6.2%, plus Medicare at 1.45% adds another $1,663. If you are in California, state income tax at 9.3% pulls another $2,325. The bar has already shrunk before you touch the money. Federal takes $5,500. FICA takes $1,663. California takes $2,325. The bar is now sitting at $16,312. That is what lands in your account, not $25,000. $16,312. This is what I call the gross gap. The company did not lie to you. They paid $25,000. But the system intercepted $8,688 of it before you ever saw it. The gross gap is the distance between what the agreement says you owe and what you actually have available to pay it back. Here's where it gets structural. The clawback clause in your agreement does not care about the gross gap. It was written around the gross number. It says you owe $25,000, not $16,000, not the amount you received, the full gross figure. Every dollar the government took is still your problem at repayment time. If you want to see how deep this goes, subscribe to Paycheck Playbook. This is the kind of math your HR department will never walk you through at offer signing. We publish one of these every week. Now let us look at why the obvious solution does not actually solve it. The moment most people hear about the gross gap, they ask the same question. Can I just get the taxes back? The answer is technically yes. In practice, it almost never saves you in time. This is the second layer of the trap. I call it the recovery lag. Under IRC Section 1341, the claim of right doctrine if you repay money in a different tax year from when you received it. You can file an amended return or claim a credit on your current year return for the federal income taxes you overpaid. If the repayment is over $3,000, which a sign-on bonus clawback almost always is, you run two calculations and take whichever gives you the larger benefit. In a good scenario, this could put $8,000 back on your tax bill as a direct credit, not a deduction, an actual credit. That is real money. But here is the recovery lag. Your clawback letter gives you 30 days to send back $25,000. Your IRC 1341 credit does not arrive in 30 days. It arrives when you file your amended return, which the IRS processes in anywhere from several months to over a year. You need the cash now. The refund comes later. And the FICA portion, the Social Security and Medicare taxes, those do not come back through your tax return at all. Recovering FICA requires your former employer to file a corrected payroll form with the IRS and then credit you back. Many employers do not initiate this process without being pushed. Some cannot do it for prior year payroll at all. Marcus left a tech company in March. He had received a $25,000 sign-on bonus the previous December. He owed the full gross amount back. He filed an amended return. 14 months later, he received a federal credit of roughly $5,000. He never recovered the FICA. The net result was that the bonus cost him more than $3,000 out of pocket after everything settled. He thought he was protected by the tax code. He was, just not on the timeline that mattered. Now let us look at the structure of the agreement itself, because this is where most people discover they signed something much more dangerous than they realized. There are 4 common clawback structures in use today. The first is full repayment. You owe the entire bonus if you leave before the end date. Leave at month 18 of a 24-month agreement and you owe the full amount. No credit for time served. The second is pro rata. You owe only the proportional amount for the time remaining. Leave at month 18 of 24 and you owe 25% on a $40,000 bonus. That is $10,000 instead of $40,000. Same situation. Completely different financial outcome. The third structure is cliff expiration. You owe everything until a specific date, then the obligation drops to 0. Leave at month 23 of 24 and you owe the full amount. Wait 5 more weeks and you owe nothing. The fourth is tiered reduction, where the obligation steps down at defined intervals. The most dangerous combination is full repayment with a cliff. The most employee-friendly is pro rata. The language in your specific agreement determines which world you live in. And here is the reality most people face. They signed the agreement during the excitement of accepting a new offer. They did not negotiate the structure. They did not even know the structure was negotiable. Here is the natural objection. If I am laid off, surely the clawback does not apply. That feels unconscionable. And in most states, until recently, you would have been wrong. Courts in most jurisdictions have upheld clawback provisions, even in voluntary termination scenarios when the agreement used language like terminates for any reason. You could lose your job through no fault of your own and still get a letter demanding $25,000. This is where the second layer of the story changes depending on where you live. California Assembly Bill 692 took effect on January 1st of 2026. For any sign-on bonus agreement signed on or after that date in California, the rules are fundamentally different. 7 conditions now apply. The clawback terms must be in a separate document from your offer letter. You must be given at least 5 business days to review it and told you have the right to consult a lawyer. The commitment period cannot exceed 24 months. No interest can accrue on the amount owed. The repayment structure must be pro rata. You must be given the option to defer receiving the bonus until the retention date with no repayment obligation at all. And critically, the clawback can only be triggered by your voluntary resignation or your own misconduct. A layoff does not count. A restructuring does not count. If the company eliminates your position, they cannot come after the bonus. Violations carry a penalty of $5,000 per employee plus attorney fees, plus the right to a representative action under California's Private Attorneys General Act. This is a significant shift. The gross gap still exists in California. The recovery lag still exists, but the cliff structure is gone. The layoff trap is gone. The buried in the offer letter problem is gone for new agreements. If you are outside California, none of this applies. You are negotiating under the old rules, and even in California, agreements signed before January 1st of 2026 are not affected. The law does not reach backward. So what do you actually do with this information? Here is the protocol. Step 1 is read the structure before you sign. Before you accept any offer with a sign-on bonus, locate the clawback clause and identify which of the 4 structures applies. Full repayment cliff is the most dangerous. Pro rata is the most reasonable. If the clause says terminates for any reason, ask HR explicitly whether layoff triggers repayment. Get the answer in writing. In California, for agreements signed after January 1st, 2026, pro rata is legally required. Everywhere else, you have to negotiate it or accept what is written. Step 2 is calculate your actual exposure before you spend the money. Take the gross bonus amount, multiply by your combined withholding rate, federal plus FICA plus state. That is your gross gap. The remainder is what you actually have. If you are in a full repayment structure and you leave at any point before the deadline, you need the full gross amount, not the net amount. Treat the difference as money that does not exist. Do not put it toward the move, the furniture, the celebration. Put it somewhere you do not touch it until the commitment period expires. Step 3 is negotiate the structure at the time of offer. Most candidates assume compensation terms are fixed. They are not. If you are receiving a meaningful sign-on bonus, you have leverage in the negotiation. Ask for pro rata instead of full repayment. Ask for layoff protection language. Ask for the retention period to be reduced from 24 months to 12. If a company refuses all 3 on a large bonus, That tells you something about how they expect the relationship to go. The cost of asking is zero. The cost of not asking can be measured in thousands of dollars. Think about what the gross gap actually represents. $8,688 on a $25,000 bonus. That is roughly 17 days of work at the salary that came with the job. You did 17 days of work for free, not because you made a bad decision, because you signed a document that was written by lawyers for the company, not for you, and the system withheld money before you ever touched it. The recovery lag means the tax code can eventually make you whole on the federal piece, but eventually is not the same as now, and now is when the letter arrives. The sign-on bonus is not a gift. It is a conditional advance. The condition is your continued presence. The advance is paid in gross. The obligation at repayment is gross. And the gap between those two facts is what this episode is about. Drop a comment with a clawback structure in your current or most recent agreement. Pro rata, full repayment, cliff, or you had no idea there was a clause at all. And if you are a job changer in tech, finance, or consulting who wants this kind of math broken down every week, hit subscribe. This is Paycheck Playbook. I am Drew. I will see you in the next one. This content is made to inform and entertain. I am not a financial advisor, and the ideas shared here are not personal financial advice. Always do your own research before acting with your money. Some voices or visuals may use AI assistance, but the final content is reviewed, edited, and approved by me, Drew.